Debt is a powerful tool, and like any tool, it can be used for good or bad. While billionaires have access to resources and strategies most of us don't, it's not about blindly copying them. We'll explore the concepts behind their strategies and emphasize the importance of responsible financial management for everyone. Hey everyone, and welcome back to the channel, You're Worthy. Today, we're diving into a topic that often sparks debate: debt and billionaires. We all know they're swimming in money, but how do they use debt to their advantage? Buckle up, because we're about to break down 10 ways billionaires make money with debt. 1. Leverage for real estate investment. Sam Zell, a real estate mogul, is known for his aggressive use of leverage to build his empire. He started with a small investment and used debt to acquire undervalued properties, renovate them, and eventually sell them for significant profits. Imagine you have $100,000 in cash. You could use this to buy a property worth $100,000 outright. However, this limits your potential return. Instead, you could use your $100,000 as a down payment, 20%, on a property worth $500,000. This requires a mortgage for the remaining $400,000. If the property value increases by 10% after a year, the property is now worth $550,000. Your initial investment of $100,000 has grown to $150,000, your share of the increased value. This represents a 150% return on your investment compared to the 10% appreciation you would have received if you bought the property outright. 2. Leveraged buyouts, LBOs. A leveraged buyout, LBO, is a financial maneuver where a company is acquired using a significant amount of borrowed funds. Here's how it typically works. An investment firm, like a private equity firm, identifies a target company. This company might be undervalued, have potential for improvement, or be in a desirable industry. The investment firm raises capital from various sources like banks, pension funds, and other investors. This capital forms the majority of the purchase price. Firm uses the raised capital and borrowed funds, debt, to acquire the target company. The target company's assets and future cash flow serve as collateral for the debt. Once acquired, the investment firm implements various strategies to increase the target company's value. This might involve restructuring operations, selling off non-core assets, improving efficiency, or growing the business. After increasing the target company's value, the investment firm exits their investment. This can be done through an initial public offering, IPO, selling the company to another buyer, or taking it private again. 3. Debt-fueled expansion. Debt-fueled expansion is a strategy where businesses leverage borrowed funds to accelerate their growth. This involves using debt to finance various initiatives like opening new stores or factories, entering new markets, investing in research and development, R&D, acquiring other companies. Elon Musk, the CEO of Tesla and SpaceX, is known for his aggressive use of debt to fuel the rapid expansion of both companies. He has used debt to build new factories, launch new car models, and invest in ambitious projects like Starlink satellite internet. While this strategy has led to significant growth for these companies, it also carries inherent risks. It's crucial for companies to carefully assess their financial situation, market conditions, and risk tolerance before embarking on debt-fueled expansion strategies. 4. Bridge loans for acquisitions. A bridge loan is a short-term, high-interest loan used to temporarily cover a gap in financing during a business transaction. In the context of acquisitions, billionaires might utilize bridge loans for various reasons: funding gap between securing funding and closing the deal, securing time for due diligence, maintaining momentum in negotiations. Bill Gates reportedly used a bridge loan to acquire Pacific Coast Software in 1986. This acquisition was crucial in the development of Microsoft, as it provided the company with the operating system technology that formed the foundation for Windows. 5. Tax optimization strategies with debt. Imagine a billionaire owns a valuable piece of art, but wants to defer paying capital gains tax on its eventual sale. They could borrow money against the art's value, using the loan proceeds for investments or other purposes. While they would pay interest on the loan, it could be strategically timed to minimize their overall tax burden compared to selling the art directly. Tax optimization strategies involve legally minimizing the amount of taxes an individual or business owes. While not inherently unethical, some strategies, including those involving debt, can be controversial and raise ethical concerns. 6. Investing in growth companies with debt. Billionaires or any investor can borrow money from various sources like banks, venture capital firms, or margin accounts. The borrowed funds are used to invest in shares of companies believed to have significant growth potential. If the company experiences significant growth and its stock price increases, the investor can sell their shares for a substantial profit, even after factoring in the cost of borrowing, interest payments. Many venture capital firms utilize a combination of their own capital and borrowed funds to invest in early-stage companies. For example, a venture capital firm might raise $1 billion from institutional investors and use a portion of that money, along with borrowed capital, to invest in promising startups in the technology sector. If one of their portfolio companies goes public and its stock price soars, the venture capital firm can generate significant returns for its investors, even after factoring in the cost of borrowing. 7. Building holding companies with debt. Warren Buffett's Berkshire Hathaway is a well-known example of a holding company that utilizes debt strategically. They have acquired various companies in diverse industries like insurance, energy, and consumer goods under the Berkshire Hathaway umbrella. By leveraging debt when necessary, they have been able to finance acquisitions, invest in other assets, and grow their overall portfolio. A holding company is a parent company that owns and controls other companies, known as subsidiaries. Billionaires may strategically use debt to establish and operate holding companies for various reasons: centralized financial management, access to favorable borrowing rates, flexibility for acquisitions and investments. 8. Personal debt for investments. In this strategy, billionaires or any individual use personal loans or margin accounts to invest in assets like stocks, real estate, or other ventures. This essentially involves leveraging their personal assets and future income to potentially amplify their investment returns. Imagine an individual borrows $100,000 from a bank to invest in a specific stock. If the stock price doubles, they could potentially make a $100,000 profit. However, if the stock price instead falls by half, they would owe the bank $100,000 plus interest, even though their investment is now only worth $50,000. This scenario highlights the extreme risk involved in using personal debt for investments. 9. Debt-fueled research and development, R&D. In the competitive world of technology and innovation, some billionaires leverage debt to fund research and development, R&D, initiatives within their companies. Alphabet, Google's parent company, is known for its aggressive investment in R&D. They utilize various sources of funding, including debt, to finance a diverse range of projects, from self-driving cars to artificial intelligence advancements. While some of these projects have yielded significant returns, others have not been successful. This example highlights the high risk and potential reward associated with using debt for R&D. 10. Debt for philanthropy. This strategy involves using borrowed funds to finance philanthropic endeavors. While seemingly counterintuitive, some billionaires believe the potential social impact outweighs the financial risk associated with debt. Imagine a billionaire passionate about climate change. They could utilize borrowed funds to invest in renewable energy companies or sustainable infrastructure projects. While there is a risk of financial loss, if successful, the investment could generate returns that can be used to further support climate change initiatives and potentially create a positive environmental impact. And there you have it, 10 ways billionaires make money with debt. While debt can be risky, when used wisely, it can be a powerful tool for building wealth. We hope you found this exploration insightful. Remember, financial success is within your reach. Stay tuned for more valuable content on Your Worthy. Thank you for watching.